This week in economics on the 1st of June, 2014, our first program for June. We have a number of things we need to clear away as we normally do. When we finish our part of this presentation, you'll hear from the French professor Thomas Piketty, and he's being interviewed by Foreign Affairs. Now, Foreign Affairs is a mainstream publication. Many people get it. We used to be a regular subscriber to it. Course went up, we went out, so to speak. But nonetheless, he explains his recent book, and it has been talked about across the U.S., and there was some, we'll say, controversy about the book, and we'll get to a little bit of that in a minute. We'll first get to some of the numbers. Let me make some general commentaries on Professor Piketty's book and why there are so many problems. Capital in the 21st century. He compares capital today to what was called the Gilded Age. That was an era around the First World War. And I know many people don't think of that, but that was in the early 1900s, before what is usually called the Great Patriotic War, or World War II, when much of the economic wherewithal engine started to ignite in the late 40s because of war production, and then, of course, because of the policies of Franklin Delano Roosevelt. But we won't get into those as much as we'll explain some of the backbone here, and we'll post more information, and there's information all around that you can find on our blog, the Numbers Man blog, which is Economics 2014 at WordPress. And you can find that at the Boston Red Network. That's our family of programs. More will arrive there as we get around to it. But let's first go to some of the basic numbers that we need to look at, and then we'll devote some time to Professor Piketty, Thomas Piketty. We'll look at real domestic product. This is from the Department of Commerce. It's always out there. This information, let's see, what was the date on it? The 29th there. And I'll just read a little bit of it. We'll kind of move along because of our time. Real domestic product, the output of goods and services produced by labor and property located in the U.S. This is from the Bureau of Economic Analysis. In the fourth quarter, real GMP increased to 2.6%. The estimate released today is based upon a more complete source of data than were available for the advanced estimate issued last month. In the advanced estimate, real GMP was estimated to have increased at 0.110%, with the second estimate from the first quarter, the decline in private inventory was larger than previously estimated. The decrease in GMP in the first quarter primarily reflects negative contributions from private inventory, investment, exports, non-residential fixed investments, state and local government spending, and residential fixed investments that were partially offset by a positive contribution from personal consumption expenditures. Import were a subtraction in the calculation there. So let's take a look. The annual revision of national income and product accounts will be released, on the 30th of July. That's for the second quarter. In addition, the regular revisions of estimates for the most recent 3 years of the first quarter of 2014, GMP and select components will be released back to the first quarter of 1999. And a little more explanation here. The downturn in percentage change in real GMP reflects a downturn in exports, a large decrease in private investment, inventory investment, downturn in non-residential fixed investment, and in state and local government spending. We hadn't seen this occur for a while. The price index for gross domestic product, which measures prices paid by U.S. residents, increased 1.3% in the first quarter, 0.1% less than the advance index increase at 1.5% in the fourth quarter, excluding food and energy pricing. Real personal income consumption expenditures increased 3.1% in the first quarter, compared with an increase of 3.3% in the fourth quarter. Durable goods increased 1.4% compared with an increase of 2.8%. Non-durable goods increased 0.4% compared with an increase of 2.9%. Services increased 4.3% compared with an increase of 3.5%. Real income. Wait a minute. Go back here. Real non-residential fixed income decreased 1.6% in the first quarter, in contrast to an increase of 5.7% in the fourth quarter. That would be of last year. Investment in non-residential structures decreased 7.5% compared with a decrease of 1.8%. Investment in equipment decreased by 3.1% in contrast to an increase, that would be back to Q4 of last year, of 10.9%. Investment in intellectual property increased 5.1% compared with an increase of 4% last year. Real residential fixed investment decreased 5% compared with a decrease of 7.9%. So it's kind of a mixed bag. Real export of goods and services decreased 6% in the first quarter, Q1, in contrast to an increase of 9.5% in the fourth quarter. Real imports of goods and services increased 0.7% compared with an increase of 0.15% in Q4. Real federal government consumption expenditures and gross investment increased 0.7% in the first quarter, contrasted with a decrease of 12.8% in Q4 last year. National defense decreased by 2.4% compared with a decrease of 14% last quarter. That would be Q4. Non-defense increased 5.9% in contrast to a decrease of 10%. Real state and local government consumption expenditures and gross investment decreased 1.8% in Q4, and it was unchanged in Q1. Unchanged from Q4 last year. The change in real private inventory subtracted 1.62% from the first quarter. Change in real GMP after subtracting 0.02 percentage points from the fourth quarter change. Private business increased inventories at $49 billion in the first quarter, following a $111.7 billion in the fourth quarter and $115.7 billion in the third quarter. Final sales of domestic products, GMP less changed in private inventories, increased 0.6% in the first quarter compared with an increase of 0.27% in the fourth quarter. Gross domestic purchases, real gross domestic purchases by U.S. residents of goods and services, was unchanged in Q1, followed by an increase of 1.6% in Q4. In other words, it's the same in Q1 of this year. Gross national product, real gross national product, supplied by U.S. residents decreased 2.1% in Q1, first quarter, in contrast to an increase of 3.1% in the fourth quarter. GMP includes and GMP exclude net receipts of income from the rest of the world, which decreased $42.4 billion in the first quarter, in contrast to an increase of 17 billion in the fourth quarter, and in the first quarter receipts decreased 27 billion and payments increased 13.4 billion. Current dollar GMP, the market value of the nation's outputs of goods and services increased 0.3% or 11.7 billion in the first quarter to a level of 17102 billion. In the fourth quarter, current dollar assets current dollar GMP increased 4.2% or 176.7 billion. So that was 101.3 billion or of their 17 million anyway. Quite substantial GMP output. Gross domestic income, and GDI, which measures the output of economy as the cost incurred and income earned in production of GMP, decreased 2.3% in the first quarter, in contrast to 6.2%, and that was revised in the fourth. For a given quarter, the estimate of GMP and GDI may differ for a variety of reasons, including incorporation of large independent sources of data. However, over long time spans, the estimate of GDP and GDI tend to follow similar patterns of change. Now, some revisions. The second estimate of first quarter percent change in real GDP was revised down 1.1% or 43.7 billion from advanced estimate issued last month, primarily reflecting a downward revision to private inventory investment and upward revision to import that were partially offset by an upward revision to exports. It's an interesting situation there. Corporate profits. Glad to get out of there. From inventory valuation adjustment and capital consumption adjustments decreased 213.4 billion in the first quarter, in contrast to an increase of 47.1 billion in the fourth. The IVA, that's the inventory value adjustment, decreased 32.3 billion compared with a decrease of 0.5 billion there. So if we look at the capital adjustment, decreased 82.5 billion compared with a decrease of 1.5 billion there. Taxes on corporate income, something Dr. Piketty will talk about, 27.2 billion in the first quarter compared with an increase of 13.3 billion in the fourth. Profits on after tax decreased 239.5 billion in contrast to an increase of 33.8 billion. First, for the changes in corporate tax income, Mahler effect, the expiration of bonus depreciation provisions there. Dividend decreased 89.89 billion in the first quarter, in contrast to an increase of 90.5 billion in the fourth. Undistributed profits decreased by 150.6 billion compared with a decrease of 56.7 billion. Net cash flow with internal funds available for corporations for investment decreased 131.6 billion compared with 43 billion in Q4. The impact of bonus depreciation on the first quarter, that's of 2014. Changes in corporate tax and corporate consumption adjustments mainly reflect the expiration of both the 50% bonus depreciation provision and increase in Section 179, expanding limits claimed under the American Taxpayer Relief Act of 2012. Bonus depreciation does not affect profits from current production. Profits from current production are based on consistent depreciation profiles of fixed assets valued at current costs and not on depreciation of accounting practices used for federal income tax returns. Domestic profit of financial corporations decreased $70.6 billion in the first quarter, in contrast to an increase of $6.1 billion in the fourth. Domestic profits of non-financial corporations decreased $102.3 billion, in contrast to an increase of $18.1. The rest of the world component of profits decreased $40.4 billion in the fourth quarter, in contrast to $22.9 billion in the fourth quarter. The measurement is calculates the difference between receipts from the rest of the world and payments to the rest of the world. Receipts decreased $32.3 billion and payments increased $8.6 billion. Real gross value added of non-financial corporations decreased 2.2% in the first quarter. Profits per unit of real added value decreased, reflecting an increase in the unit labor and non-labor costs incurred by corporations that were partially offset by an increase in unit price. Now, what basically that is telling you that the cost of things went up, so we continue to monitor inflation there. Took us a little while to get through that, but kind of important to start things moving along here. Let's go to Reuters here, and what we just talked about. Consumer spending dropped 0.1%, which is the first decline since April of 2013. The disappointing spending report, no doubt about that. The Reuters University of Michigan index fell to 81.9 in May from 84.1 in April, but was up slightly from earlier this month. And the supply management people out in Chicago showed factory activity in the Midwest reached its highest level in 7 months in May. So in other words, kind of a mixed report there. And inflation, prices rose 0.2% in April, pushing up the year-over-year at 1.6%. The largest gain since November. Well, we need to get inflation up to about 2.53% to get some more growth going here. And of course, that's excluding food and energy prices increased 0.2%. These so-called core prices were up 1.4% from a year ago. Federal Reserve, their target is 2%, but in actuality, it's about 5%. Let's quickly go to Professor Piketty's book and some of the debate here. Now, this is from Bloomberg. This is from Cleve Cook. The main defect in Thomas Piketty's Capital in the 20th Century has little to do with a question about data that the Financial Times raised. We talked about that last week. Nonetheless, they're good questions. The FT should be thanked for raising it. I argue that the main thing wrong with the book is that it makes large claims than it fails to support. Piketty says capitalism embraces a fundamental contradiction. I agree with him on that. In the nature of the systems of inequality of income and wealth tend to rise inexorbitantly with plutocracy of a logical consequence. He provides a theory of sorts to back this up. This is Mr. Cork talking here, but far from compelling. And assuming they are correct in one way, the Financial Times finding some of Mr. Piketty's numbers are suspect doesn't advance the discussion very much. Indeed. We're talking about data here, and he runs across several societies, and on our blog we'll put those studies there where you can look at those. And let's get the wider Bloomberg thing here. He did, in fact, write a 4400 defense of his book on inequality and posted on his website. And we'll just briefly go over some of that. We won't spend a lot of time because he goes on to talk about it. This is a response to criticisms. This is from Professor Piketty, Thomas Piketty. And we just kind of hit it here. The world top income database is set to become a world of wealth and income database. The running theme here is that we get better data. Now, they did ignore Zuckman and 2014 survey, which we read. It is a slide presentation here, and we'll just kind of briefly, very, very briefly indeed, look at it. This is by Emmanuel Zelks. He's at the University SAEZ at Berkeley. And, of course, Gabriel Zuckman is at also Berkeley. This came out in 2014. Is rising inequality purely a labor income phenomenon? This is some of their slides here. The rise in top incomes due to top wage earners and entrepreneurs. The working rich may not have enough time to accumulate. And they put it here, income equality has increased sharply since 1980, yet surveys have shown modest increase in wealth concentration. And they answered no to this. We find that capital inequality also rises there based on new estimates of wealth and capital income distribution. We find large increases in the 1/10 income share since 1980. Wealth above 20 million today is back to the roaring 20s. No increase in wealth inequality tops the 1/10 so far. We've developed a technique to estimate it. We capitalize income tax returns. This is IRS data here. Compute rates of return by asset class, flows of funds, combined income and rates of return to obtain wealth. The capitalization wealth works for foundations. We are not the first, but they have a better data set. And they talk about King in 1927, Stewart in 1939, Atchison in 1978, and Greenwood in 1983. You can see what's happening here. The Forbes ranking, larger increase in wealth concentration, but methodological issues. Estimate estate tax, no increase in the top 1% shares since the 80s, but only 1 in 1,000 but pay tax today via discounts. Well, anyway, a consistent study of incomes and wealth. Capitalization methods forced us to jointly study distribution, total net household wealth at market value, W. We won't go into all that, but the outline of their talk: aggregated wealth, capital income, rates of return, capitalization method, distribution of income, disposing wealth, accumulation, distribution of saving rates, and the rise here. We just kind of hit by very, very sharply here. The U capital share return volatility is back. These are just some of their slides. To obtain wealth, we multiply the reported income by the inversion of rate of return. So they have good data sets to work on. This just came out in March. We'll post a link to this. How we deal with avoidance and evasion, tax avoidance, a systematic reconciliation exercise of national accounts to identify potential gaps in income data. Tax evasion, third-party reporting means all dividend interest earned through domestic banks well declared. Problem with offshore wealth is a problem. Two potential issues there may differ in the increase since 1970. I'm just kind of hitting the high points of that slide. The rich did collect a lot of dividends in the 1970s. Not so much these days. Dividends don't pay out as much. The capitalization method works for foundations. And then they show wealth distribution from 1913 to 2012 using some nice graphics here. 1% has gained more than 10%. The rise and fall of middle-class wealth. Some of the things that they've hit here. I'm flying on through this as quickly. It's about 62 pages. The graph is here, and theirs is a nice complement to Professor Piketty's particular situation here. Fixed claims, business assets, sole proprietorship, farm, housing owners, and so forth, pensions, equities. They go through all of this. What tax data missed? Most trusted generated income taxable at most trusts at the individual level. And they actually go into much detail about the breakdown of the U.S. economy, improve estimations with internal data, no doubt about that. They even go into IRAs and that sort of thing. So those are some of the things that Professor Piketty talks about, and he'll go to him. We'll get to the numbers now. And just a couple of other things. The Indian economy has disappointed. This is from the BBC. Slower than forecast annual pace of 4.6%. That's between January there and the second straight year of subpar 5% can be expected. That manufacturing sector contrast at an annualized rate of 1.4% over the quarter. The mining sector at 0.4%. Offsetting this was 6.3% in agriculture. India has a very large agriculture sector. Most people don't realize that, but it does indeed. We'll get to our numbers very quickly here as we're running a little late. The FTSE was down 26.78. The DAC at 4.37. In Paris, they were also down at 10.94. In Brussels, 1.59. In Madrid, 63.90. In Zurich, down 31.98. In Moscow, down 9.92. In Johannesburg, down to 94.82. In Bombay, they were also down 33.2.17. These are all on Friday, incidentally. In Karachi, 197.11. Lahore, they were also down 42.28. Colombo also 40.31 in the negative. And in Tehran, they were also down 178.60 on Wednesday. In Sydney, down 25.40. The Nikkei was also down 49.34. And in Hong Kong, the Hang Seng on Friday was at 71.51. In Shanghai, 1.38 in the negative. In New York, 18.43. The Nasdaq, 17.54. And the Merc, 3.5. 1.54. In San Pablo, 1,000 in the negative. In Mexico, also 647.41 in the negative there. And a quick look at our all-impressive commodities and see where some of that inflation. Well, actually, we're down. Brent crude, these are futures, down 41 cents at 109.56, and the spot was down 83 cents at 109.47. West Texas Intermediate was down 65 cents at 102 and 87 cents. TBM picking is still doing double somersaults there. Dubai Go futures down $2.50 at $1,255.80. We don't hear as much about Go. This will do it for us. On to Professor Thomas Piketty of the Paris School of Economics. Have a good weekend for those in business. Make next week a productive one. For the consumer, keep your eye on the ball.
Hello, I'm Justin Vogt, Deputy Managing Editor of Foreign Affairs, and this is Foreign Affairs Focus on Books. This is a new interview series that we're launching today, and we could not be more pleased than to have as our first guest Thomas Piketty, Professor of Economics at the Paris School of Economics, and the author of the highly anticipated new book, Capital in the 21st Century, which is reviewed in the brand new issue of Foreign Affairs. Professor Piketty, thank you so much for joining us today.
Thanks for inviting me.
Now, you are best known for your work in demonstrating how in recent decades income inequality has grown to levels really that have brought us to something like a new Gilded Age, at least in the United States, where we now have the wealthiest 1% or even the wealthiest 0.1% controlling a proportion of income that we haven't seen in a century. At the same time, others contend that, well, you know, all boats have risen during the same amount of time. And my question for you is, why should this kind of economic inequality be something that we're worried about? Why should people care about this kind of economic inequality?
I think inequality is fine as long as it is in the common interest. The problem is when it gets so extreme, when it becomes excessive. So the very difficult question, of course, is when is it that it becomes excessive and it becomes useless for society? And let me say right away that, you know, I don't have, you know, mathematical response to this question. So what I'm trying to do in this book, you know, is to put a lot of historical evidence into this debate so that, you know, it's not that we are going to stop fighting about inequality. You know, people have been fighting about inequality forever, and this will continue. But at least we will know a little bit more what we are fighting about. So the primary objective of this book, which comes from an international research project where we have been collecting historical data on income and wealth in over 20 countries since the Industrial Revolution. You know, the primary objective is to try to present this data, you know, in a consistent manner. Then at the end of the book, you know, I draw some, you know, conclusion about the future, but let me make perfectly clear that, you know, even if people disagree entirely about my conclusion, this is fine. They will still, I think, find some interest in the history of income and wealth that is presented in part 1, 2, and 3 of the book. And you know, if to answer more precisely to your question, I think one of the historical lessons of the book is that we don't need the kind of inequality that we had in the 19th century in order to grow. So one of the lessons of the 20th century is that 19th century inequality was not useful for growth. You know, it was destroyed by the world wars. It was also changed by policies, progressive taxation, the welfare state, so that European countries in particular that had a very extreme concentration of wealth until World War I had a much more equal distribution of property in the 50s, 60s, and this did not prevent growth from happening. Quite the opposite. In fact, probably the reduction in wealth inequality increased mobility, upward mobility. You know, the people in the middle class started to accumulate wealth, and this was probably good for growth as well. So, you know, we should be worried about returning to the kind of extreme inequalities that we had in the 19th century. That doesn't mean that we want full equality, of course, but we have to be careful about the fact that the trends, the pure economic forces, can get us, further away from our ideals than we would like it to be. And there's no natural force that prevents this from happening again.
Your new book is built around a simple but profound observation about an economic relationship between the rate of growth and the rate of, in turn, returns enjoyed by investors. You express this as R is greater than G. In other words, the rate of return enjoyed by investors and capitalists often outstrips the overall growth in the economy. Can you explain that relationship and also explain why it's such a powerful dynamic?
Okay, so R bigger than G, today can seem paradoxical, but in fact, during most of human history, this was really obvious to everyone. Although people did not formulate it this way, this was obvious because the growth rate was close to 0%. Population was more or less stagnant. Productivity growth was very small, less than 0.1% per year. So maybe, say 0%. And the rate of return to capital, of course, was positive. So typically, landowners in traditional societies will get an annual rent to their land that was of the order of 4 to 5% of the value of the land. So, the traditional formula was, the price of land is the equivalent of 20 or 25 years of annual rent to the land. And, when you read novels of Jane Austen or, whoever, you will see that everybody at that time knew that, if you want an annual return of £1,000, you need a capital of £20,000, and this was obvious to everyone. And in a way, this was even the foundation of society, because this is what allowed group of landowners or owners of whatever assets there was to own to sustain and to be able to do other things than just care about their own survival.
In other words, the rate of return had to be greater than the rate of growth in order for there to be a sort of profit incentive.
Well, not a profit incentive, a way to live. They were living off their rent, and this allowed them, to do different other activities. Maybe Then during the 20th century, a number of very unusual events made this inequality R bigger than G stop being true. And first, because between 1914 and 1945, you had huge capital shocks, capital destruction, inflation that reduced tremendously the return to private assets. Then the growth rate itself increased a lot in the post-war period, partly because of the recovery after the war, and partly because of very large population growth. The baby boom cohort, the demographic transition was not over yet, so you had unusually high rate of economic growth due to these two factors. And now we are back, starting in the 1980s, 1990s, we are back to a situation where growth rate, at least in the most developed countries, are down to lower levels, in particular because of the decline in population growth. And the rate of return itself is back to relatively high levels, in particular due to international competition to attract capital investment. So we are back to this inequality R bigger than G, which we had sort of forgotten because during sort of a very long time period during the 20th century it ceased to be true. But it's quite likely that this is going to be with us for a long time, and that's certainly an important force that tends to push toward rising initial wealth disparities tend to rise, because if you start with higher wealth, it's easier to grow than if you start just with your slowly growing labor income.
And so here we are in the present day, where we see these really striking inequalities of wealth. In your book, you put forward two prescriptions for how to deal with this from a policy point of view. The first is essentially raising income taxes to a fairly high level, at the highest bracket, somewhere around 80% even. And then also what you call a global wealth tax on all kinds of assets. Can you explain why you think those steps would work?
Well, first of all, the best policy, of course, is to raise the growth rate. So the first thing that you want to do is to raise the growth rate. The other thing that you want to do is to raise education, which is the major way to reduce inequality in earnings. The question is that going to be sufficient? Now, if you look at the rise of very top managerial compensation in recent decades in the US, I think it's not mostly a problem of lack of education of people below the top. It has more to do with the fact that you have a group of very top managers that were able to a large extent to set their own pay, irrespective of performance. In the past few decades in the US, you have rising inequality, rising top managerial compensation everywhere, except in the growth statistics, because the growth performance has actually been declining. So in the United States, the share of national wealth going to the bottom 50% is just 2%, and the next 40%, which you can call the middle class, are getting, about 23%, and then you have 75% for the top 10. So, it's very extreme concentration of wealth, and what I'm saying is that we need to find ways to increase wealth mobility and the opportunities for wealth accumulation by this group and limit the extreme concentration of wealth at the top. One way to do that, that doesn't have to be global. There's a lot that can be done at the national level, especially in large countries like the United States. You could very well transform the property tax into a progressive tax on net wealth, so that in effect you will reduce the property tax that's paid by the bottom, 90% of the population. If you have $500,000 in your house, but if you have a mortgage of $490,000, you're not rich. Your net wealth is $10,000. So in what I propose, you will not pay any progressive tax on net wealth, and whereas now you pay as much property tax as someone with no debt. So that would allow more people to accumulate wealth, and that will certainly not reduce the total quantity of wealth. I think one big lesson of the 20th century is that we don't need to have all the wealth to the top 10%, top 1%. We can have a lot of wealth accumulation from the middle class, and that kind of progressive tax on net wealth would allow that to happen. More wealth mobility, more accumulation of wealth by the middle class, and less extreme concentration of wealth in the hands of a few, which is bad for middle class wealth and bad also for the working of our democratic institutions.
Let me ask you, the economist Tyler Cowen, who reviews your book in Foreign Affairs in the new issue, he faults you for essentially what he sees as your failure to see that there's a potential for abuse on the part of the state or of government, that if you're allowing states or governments to take a wealth tax or to tax at higher rates, that they are giving them the power to redistribute. He says that he writes that the best parts of your book argue that left unchecked, capital and capitalists inevitably accrue too much power. And yet you seem to believe that governments and politicians are somehow exempt from the same dynamic. Do you have any response to that critique?
Well, my response is that we should subject government to constant and critical scrutiny and democratic institutions, and I believe in direct democracy. I also believe in representative democracy. But in any case, we certainly need to think hard on how to make our government as accountable as possible. I don't think the same can be said of billionaire or individual holders of fortunes. Where is democratic accountability here? So I'm not so sure. I guess 1 century ago, many people in this country, would have said that progressive income tax is not something you want to give to the federal government, and indeed this was a big fight, and the Constitution made it impossible to happen, and then it happened, and now I think everybody agrees, or maybe even Tyler Cowen, I don't know, that a progressive income tax is a good thing. And I think we need to think hard about the progressive wealth tax, because, both are useful, but in the 21st century, wealth is likely to be more important, in particular in the United States than in the 20th and 19th century, for one simple reason, which is that population growth in this country has been enormous over the past 2 centuries, and it's probably at some point it's also gonna slow down. The American population went from 3 million 2 centuries ago to 300 today. Is that gonna go to 30 billion 2 centuries from now? Probably not. And even if you compare 1 century ago, it was 100. Is that gonna go to 900 1 century from now? Probably not. And when you have a decline in population growth, then mechanically wealth accumulated in the past becomes more important. And so if you want to keep wealth mobility, then you want to have a new balance between the taxation of the stock and the taxation of the flow. So the problem is not to expropriate wealth holders. The problem is to allow new people to enter into wealth accumulation. And for this, you need a new balance between taxation of income, taxation of wealth. And, I think we need to have this debate.
Professor Thomas Piketty, thank you so much for joining us, and thank you for watching.